What's going on, guys? Mike here, and welcome back to another video. So today's topic is Canadian banks. The three banks that we're going to be looking into today in this video is TD, Royal Bank, as well as Scotiabank. There are a few topics that we're going to be exploring in each of these banks as we look at their, in very high level detail, of their latest annual report, which is their total revenues from 2023, as well as their provisions for credit loss. And we're going to compare that to what it was in 2022. Then as we go through the annual report, we're also just going to quickly highlight on their dividend payout ratio and also look at the past 10 years of dividend payments and just kind of compare what it was back then in 2020 or 2014 and what they're paying out in 2024. And maybe that'll give us some sort of inkling as to what they'll be paying out in 2034. So starting things out with is TD Canada Trust, and right away you're going to notice how they are definitely down from their all-time highs from 2022, which is resulting in very close to 25%. Now they are paying out currently a 5% annual dividend, and if you remember, if you're familiar with TD Canada Trust, just like every other bank typically in Canada, they do increase their annual dividends year after year, which is awesome for those dividend investors. Getting over to their annual report, like I said, this is just going to be a very high level. We're not going to be diving deep into this by any means, but I just kind of want to draw your attention to their total revenue this past year. So they went from 49 billion in 2022 and 50.4 billion in 2023. So again, we're still seeing an increase in revenue, which is very important in these types of situations. But what's really crazy is their provisions for credit loss. So currently in 2022, they paid $1 billion for that. And then of course in 2023, moving 2.9 billion. So one thing to remember with this kind of market cycle that we're in, TD Canada Trust is down, like I said, 25% from their all-time highs. I technically bought into TD at $102. I've kept, purchasing it on the way down, and currently my average price is around that $86. So I'm still technically at a loss. But the one thing, like the key thing to remember is that once the interest rates start coming down, the banks will stop having to have such a large amount of capital going into provisions for credit losses, which then can be reinvested into the company, and again, which then increases the value of the stock. So this is definitely a buying opportunity that people need to kind of realize, right? So going further from the provisions for credit loss, one thing that I just always like to look at is the dividend payout ratio. So in TD, you're going to get from 2022, 42.5, and then in the latest year being 47.9. And like I said, that also includes that their annual dividends is increased year after year, which is something that's, like I said, super important. Looking at their past 10 years, you can see that TD Canada Trust was paying out 22 cents per share, and now all the way up to $1.02. So you can see how much it's increased year after year, and it makes a significant difference. Moving into Royal Bank, they're probably one of the ones that's actually in the best shape out of all the Canadian banks. Their all-time high is only being, I think it's 9%. I just got to get it measured up here. Yeah, 9% that they're currently down from their all-time highs. They are paying a bit of the lower end of their dividends at 4.16, but their annual report is definitely in good shape. You can see here in 2022, they just pulled in just under 49 billion, and in 2023 coming in just over 56 billion. That is a very healthy increase year after year. Then going down to their provisions for credit loss, definitely it's just like TD Canada Trust. In 2022, only having 484 million, and then in 2023, 2.4 billion. So again, such a significant increase. And again, this is just kind of striking up to be a buying opportunity for investors. Looking at their dividend payout ratio being at 45% in 2022, and then coming in at 51% this latest year, which is awesome. Looking at their 10-year average, they went from 67 cents all the way up to $1.38. Now getting into Scotiabank, you can definitely see that they also had a trend of falling from their all-time highs, coming in at around just under 27%. They definitely are at the higher end scale right now, and I think this is what's drawing a lot of investors to now Scotiabank, is because they're paying that 6.31%. So if you can lock in on over 6% dividend payment year after year, that's definitely something to consider. Looking at their annual report, you can see that their total revenue didn't increase as much as the other two banks, from 31.4 billion to 32.3 billion. So that's about a $900 million increase. Their provisions for credit loss definitely increased, just like the other two banks, going from 1.3 billion all the way up to 3.4 billion. Now their dividend payment isn't actually on this sheet, so I'm just going to do a quick control find, and you can see here that in 2023 their dividend payment, or sorry, their dividend payout being at 71.6%. So they are definitely on the high side. Now this one is maybe a bit more of a riskier play in the Canadian banks compared to something like TD or Royal Bank, but again, I find that investors are definitely drawn to Scotiabank at the moment just because of how high their dividend payments are currently, being in the plus 6% compared to the other two banks. I definitely think that Scotiabank is something to be definitely considered. Looking over their last 10 years of their dividend payments, you can see they've gone from in 2020 or 2014 from 62 cents up to $1.06. So definitely not as much of a growth compared to Royal Bank or TD, but definitely something to consider. Now getting into the ETF that I'm definitely interested in myself, which is from Horizon, which is HBNK. So one of the biggest things I really like about this particular ETF is that it pays out a monthly dividend. So I personally, I know that total returns is where everything needs to be, but the reason why I like monthly dividends is because on accounts that I don't contribute to, like say a Lira or my RSP on a bi-weekly contribution, it is nice to get those monthly dividends, because then you can kind of utilize that to continue to have your targets achieved, right? Like if something is dropped significantly, I can use that dividends to buy more at that time to bring it back up to my target allocations, right? Looking at the holdings here, something that I really like about this as well is it just kind of simplifies your weightings across the Canadian banks, right? So you're just basically, you buy one ETF and you're getting all the banks within Canada that really are something that are great to invest in. So it's definitely something to definitely consider. Right now they aren't actually charging a MER on this ETF, and you can see here that it's 0% until July 31st of 2024. So if you were wanting to buy into this ETF now, you could definitely get no fees charged until July. All right, guys, if you're dividend investors, I really think that HBank is definitely the way to go for if you're looking to get into the broad exposure of the Canadian banks and get a monthly income out of it. If you haven't checked out this video here, this is my latest portfolio update, and we'll see you guys next time.